I'm just going to issue billions and billions and billions of dollars of securities and buy billions and billions and billions of dollars of Bitcoin. And I'm going to digitally transform the equity and the credit capital markets from 20th century analog physical cash based to 21st century digital Bitcoin based. And that's, I think, what we see right now.
What is the next business model for Bitcoin Treasury Company? Well, the business model, you already have it. And so I will leave the floor to Michael to explain how the model is so robust due to its simplicity and how you can achieve amazing results by focusing on executing it as laser eyes focused as possible and to deliver the best results for shareholders.
Thanks. You know, I said in Vegas, you know, a corporation is the most effective wealth creation machine that we have yet devised. And if we think about the spread of Bitcoin as a monetary virus and as an idea, the super spreaders, the amplifiers of the virus are corporations. When Bitcoin hits an individual, if Bitcoin arrives, you know, at my proverbial dentist, and the dentist clocks a couple $100,000 a year or whatever, they're buying a few $100,000 of Bitcoin. And, you know, as I said, in the war to determine the future of money, right, it's going to be fought with money, right? Right? The future of money is going to be fought with and won with money. So the dentist is, he's generating a few $100,000 or she's generating a few $100,000 a year. And so over 20 years, you're going to buy $4 million of Bitcoin. When the dentist incorporates and becomes a company, the dentist is going to sell $1 million of stock, and they're going to buy $1 million of Bitcoin in a month. And when the company recapitalizes on Bitcoin, then your real opportunity is to any operating company can sell equity or sell credit, issue credit. And public companies are the best. So say you're a public company, the superpower you have as a public company is you can sell equity, you can issue warrants, you can issue bonds, convertible bonds, junk bonds, or preferred stock. And the preferred stock can have any rights. It can look like equity, it can look like convertible equity, it can look like a bond, it can have dividends or not. So when a company adopts the Bitcoin standard, that dentist that becomes a company doesn't buy $1 million of Bitcoin in 5 years, doesn't buy $1 million of Bitcoin in 1 year. The company issues $1 million of equity and buys $1 million of Bitcoin in 1 month. But it's immediately profitable, which means in the next month, the company can issue another $1 million. And so a company may very well start to issue $1 million a month of security, of equity, and then all of a sudden it's bought $10 million of Bitcoin. So now the interesting thing is, where is all the money in the world? There's $100 trillion of money in the equity capital markets. There's $300 trillion of money in the credit markets. All of the equity capital in the world is valued based upon future expectations of fiat cash flows. Every company in Nigeria is valued based upon the expectation of Nigerian cash flows. Every company in Brazil is based on Brazilian cash flows. Every company in the US, US cash flows. Okay, and we know that the value of that cash is falling, but we also know it's very competitive. So you have a long, heterogeneous, uncertain, like credit risk there, or a equity risk, we'll call it. And then with credit, all of the creditors, they're valued based upon the future expectations of cash flows. I borrow money, I don't have the money, I promise you I'll pay it back, I'm going to get the money over 10 years, right? So the existing markets are based upon these future expectations of business operation. We're valuing real world assets, we're valuing future cash flows, we're valuing equity or opportunities. And the Bitcoin treasury company idea and the most elegant business model is I have a stack of Bitcoin, $10 million of Bitcoin. I start issuing equity based upon my ability to acquire more Bitcoin. Then I issue credit, fixed credit, convertible credit, some other credit, and then I use it to buy Bitcoin. And of course, the point is when Metaplanet was a hotel, they might be able to buy $1 million of Bitcoin a year. But when Metaplanet started issuing equity, it's able to issue $1 billion of equity in a year. And so now they're buying not 1 million, but 1 billion a year. But the rate at which a company can issue equity or credit is exponential, but it's not like annual. You might be doubling every month, right? You might go into something like on October 30th, we announced a $21 billion ATM. We thought, well, if we do that in 3 years, that'll be the most successful equity program in the history of the capital markets. If we did it in 3 years, and we did it in like 3 months, because all you're doing is you're swapping equity for Bitcoin and you're swapping credit for Bitcoin. Companies can do that. Individuals can't do that, but when you put 3 individuals together and they cooperate, they become a company. So really, I wouldn't be afraid of a company. I would just say a company is when one dude that knows finance got together with one lawyer and got together with one leader, a CEO, a CFO, a general counsel. Now you have a Bitcoin treasury company. If you put Bitcoin, digital capital behind it, and now you can grow literally as fast as you can issue the security and buy the Bitcoin. And that is an investment cycle which is 1,000 times faster than a physical real estate cycle or a business cycle. So it's faster, it's homogeneous, and primarily the friction point is the issuance of securities. So it's a legal and it's a regulatory friction point, and it's different if you're Japanese than if you're French. You need Bitcoin treasury companies in the UK that understand UK law, and one in France and one in Norway and Sweden and Germany, and they're all going to have local advantages because they're, if you're a Japanese company, it's easier to issue Japanese securities than an American company going to Japan. I know this. I called Simon. I said, Simon, the good news is you'll probably beat me to issue preferred stock in the Japanese market. Go for it, right? And so I think that's the simplicity in the business model is I'm just going to issue billions and billions and billions of dollars of securities and buy billions and billions and billions of dollars of Bitcoin. And I'm going to digitally transform the equity and the credit capital markets from 20th century analog physical cash-based to 21st century digital Bitcoin-based. And that's, I think, what we see right now in the market.
So, Michael, you have built the Bitcoin treasury company bridge. You have said multiple times the best thing to do is to actually build the bridge, stand on the bridge, show that the bridge works, and then invite others to come to the bridge. And you have done an amazing work on this. And thank you so much for all you do for Bitcoin for corporations overall. We have the chance today to also have Adam that has even contributed to build the Bitcoin bridge itself through innovations like Hashcash at the time in the 1990s. And who is also extremely present in the Bitcoin treasury company analysis today. So, Adam, how do you see the evolution of Bitcoin and the Bitcoin treasury company model, and how do you have a valuation framework for the different bridges of Bitcoin treasury company, and how do you analyze them? You have even created new metrics. How do you analyze the Bitcoin treasury company business model?
Well, it's interesting to see how people are looking at it, because as with many new things, the default is people are skeptical. Why does that work? seems like magical thinking, seems recursive logic, that kind of feel. But it's quite simple, really. You can recreate the logic yourself, which is to go back to Michael's dentist example. Let's say it's a private practice. They could use their free cash flow to buy Bitcoin, but they realize they can take a loan and borrow Bitcoin. And because they have, accounts, they can maybe borrow $1 million against the practice, which has some enterprise value, and buy Bitcoin. And the dentist is a friend of yours, so he invites you to buy 10% ownership in his practice. But he knows that you can't get this favorable business loan because you're not a business. So he asks for a premium. And you do the calculation, you realize it's still a good deal, because if you want to do it yourself, your credit is less scalable. You have a worse credit risk as an unsecured lender. And so it makes sense. And so you invest in it. So now you've proven to yourself that a treasury company should have a premium. Now, once it's a public company, the market will tell you what the premium should be. And once you have a premium, you can start to use the capital markets tools. So you can sell more shares, issue more shares, and sell more shares. And if you look at it, when there's a positive premium, that will increase the Bitcoin per share, which is the North Star metric that all the treasury companies are looking at, is increasing Bitcoin per share because the shareholders are buying shares. And if they're getting more Bitcoin over time per share, that's growing their position. So the next question people come to, if you get them across those hurdles, is, well, am I overpaying? As the market bid up this premium, or the MNAV, the market cap divided by the net asset value of Bitcoin, too far? And so it's something that any investor struggles with, to think, from a risk perspective, what could go wrong if I get too enthusiastic and I buy a very high MNAV, and that turns out to be something that decays over time and normalizes lower, then I'm left holding this thing. So now I think there's some interesting factors here with treasury companies that reduce that risk. One is that the treasury companies are buying Bitcoin all the time, every month, every day. And so they're reducing your risk over time, because what you'll see is that as a treasury company buys Bitcoin, they're sort of paying for the premium. So the example I was giving is that, MicroStrategy now is the most well-known, the earliest treasury company. So I had some conversations with, people in the banking sector, investment banking sector, and they were, why does this work? I said, well, look, it's very simple. MicroStrategy was trading at around 2 times MNAV for some periods, and what yield have they achieved? How much have they increased Bitcoin per share since January last year? And they've about doubled the amount of Bitcoin. They did 73.5% last year, and about enough, this was a month or so ago, during this first 2 quarters of this year, that compounds to 2 times. So like if you bought the stock last year, you're now, the yield has paid for the two times risk premium. And so that means from here forwards, as they continue to accumulate until Bitcoin is fully saturated, you have no risk, almost no risk, because you've got to the point where you have paid a Bitcoin for each Bitcoin inside the company, and it's still operating, it's still doing its strategy. So that thought process basically lends itself to a new metric, which is how quickly does a given company pay for the premium it has. And so the premiums are different for, due to local market dynamics, due to the market tools they have, whether they're using debt or ATMs, and the MNAV, they end up in a region. And so you can see that, it was a way for me to start to feel comfortable buying Metaplanet at a 5 times premium when I was accustomed. I was relatively early in buying MicroStrategy shares, because I thought that Michael's mission here to, encourage other companies to put their treasury reserves into Bitcoin was a very good cause, and would help companies. And it surprised me, actually, it took so long for other companies to come on board, despite Michael's running a annual conference to show them and give them a playbook. So in any case, the question for me was, well, do I feel comfortable buying Metaplanet at 5? And because it's higher than MicroStrategy had. And the answer became easier what to think about once you thought about, well, how long does it take to pay for that yield? And it's actually, it's varying over time, but at one point it was 5 months. And so then I realized, well, that's actually much lower risk than it appears intuitively, because within the space of 5 months, if they continue, if nothing disrupts their ability to raise capital with the mechanism they're using for that period, then they actually get to the same 1 times MNAV after a 5-month period, and then it's upside after that. Now you do there's a lot of judgment in the execution strength of the management. In my case, I knew Alexander and I knew somebody involved with the Metaplanet, so I had some built-in trust of the people involved in running it, and that they were Bitcoiners interested in Bitcoin for its mission and so on. So that metric I expressed as the months to cover, and actually I think it was somebody sent me a screenshot which I asked where it came from, and it was from the Metaplanet quarterly presentation, and they picked it up and used it within like a few days, basically. So evidently, they thought it was useful to explain to their investors why you should buy, why you should invest in Metaplanet effectively. So I think they found it. They have a high MNAV, so it works well for them, right? Anyway, they adopted it, picked it up. So it's just a way to look at it. But I think you do have to form an opinion about the repeatability of the strategy, the scalability of the strategy as the company grows. If it's twice as big, ideally it needs to be able to raise correspondingly twice as much, or it could slow down. And whether it will be able to continue this at the same pace in a bear market as a bull market. And of course, the other factor you're looking at is what's the debt ratio. And you can see today that strategy has a relatively low debt ratio. I believe it's something in the 15% range. And on the Bitcoin side of things, the blockchain group is actually not taking on debt at all in a normal sense, because you have a Bitcoin basis convertible note, which I think is a very interesting new variant of debt. The reason that is not conventional debt is because if it fails to reach the conversion premium over the 5-year period, ultimately the company can just give back to Bitcoin because sitting ring-fenced in a bankrupt remote custodian, and so it doesn't have the same kind of tail risk. And so they were able to, at the blockchain group, to bring in what would be staggering amounts of debt if you were to do that in euros. So it enabled the blockchain group to go very quickly in its early period. So yeah, that's what I've been looking at in trying to understand and get a feel for things. I find that generally the best way to understand things is to get your hands onto it and buy, invest, try to analyze, form an opinion. You should always have your own opinion. You shouldn't rely on other people's opinions. If you're investing, you should have your own valuation model, your own thesis for why you think something's valuable. And another question I get asked sometimes is, how scalable is the treasury company play? Which is to say, if lots of companies come in, will it compress the effect, lower the MNAVs, and exhaust something? And in a way, that's a question for Michael, because he was inviting people, trying to encourage them to come in. Would that compress his strategy, right? And my intuition when asked this question is actually no, it won't, because it's an enormous market. Effectively, the treasury play, everybody buying Bitcoin personally, every fund manager putting Bitcoin into a pension fund, and all of the treasury companies are basically all participating. So everybody owning Bitcoin is participating along with the treasury companies and sovereign wealth funds and everybody in this huge arbitrage between the fiat current, which is mispricing Bitcoin, and the Bitcoin denominated future, which Hal Finney in 2009 famously just put out the what if that Bitcoin should be worth $200 trillion. Just based on the monetary premium in other assets. And so that still seems very plausible. Maybe it's a bit higher because we've onboarded a lot of inflation in the different major currencies. And so, if you look at that, it's an enormous arbitrage that will take, maybe a decade or decades to go through, even if the big cash-rich companies get involved. It's just an enormous pie. And there are probably some beneficial effects of more players. You know, it will provide more liquidity, more understanding, more certainty, standardize the model, make it work better because people's risk misunderstanding will clear up. People like react to safety in numbers and copying other people, seeing other people doing things with confidence. And so I think that, you know, and of course this activity is, you know, slowly bringing forward the Bitcoinization of the world. So it's generally absorbing Bitcoin. Yeah, another interesting thing about treasury companies buying Bitcoin is they are very mission focused on not selling Bitcoin. So they're taking Bitcoin off of the spot Bitcoin markets and storing it. And while the individual company's stock varies depending on, you know, just market psychology or somebody shorting it temporarily, things like that, that doesn't result in Bitcoin selling. It just results in the company getting compressed temporarily while they build up lots more Bitcoin and then they spring back. So it seems quite resilient as well. You know, one theory people might have is, will the MNAV get compressed and stay low, get stuck there? And you can see a good example in MetaPlanet in February this year, their MNAV got to 10, which was on the high side, and then it immediately crashed with they have a limit system in the Japanese market. Under 1,000 yen, it can only move 150 yen before there's a limit stop. And so it limit down 3 days in a row and it reopened almost 50% down. And that made the market subdued for a couple of months. But in the meantime, you know, the MetaPlanet management team continued to operate their moving strike ATM-like system and changed 1,760 Bitcoin into 5,000 Bitcoin in a couple of months. And of course, that compressed the MNAV down to 2.5. And at that point, the investors woke up and said, wow, that's cheap. So they start buying it. Once you get some buying going, a lot of people are momentum traders. They see something's happening, they bid it up. And you know, now within not too many weeks, their MNAV is back at 7. So you can see the MNAV can get reanimated. And the thing that causes that is the buildup of pressure of more Bitcoin being piled in, making it, you know, reducing the risk because it gets cheaper and cheaper in terms of the premium. So very interesting to see those, you know, fears be proven again and again in the market over time, so that we can get confidence in how this type of instrument, this type of company can behave in the market.
So Adam, you mentioned that we are going to a BTC-denominated world, the $200 trillion opportunity in today's dollars, and the future of as well the accretion and the Bitcoin per share and the MNAV and the premiums and so on. Many of these, Michael, you have been pioneering the BTC-denominated capital markets with the KPIs, the BTC KPIs, the BTC yield, the BTC gain, and the torque, and you have been putting together a lot of metrics for the financial industry overall to be able to value Bitcoin treasury companies. And you are also aggressively now tapping into credit markets, and you are issuing new products that allow to maybe challenge this form of consensus view that the premium should go to 1 over time or something like this. Effectively, with the instruments that you are leveraging, potentially you are enabling the premium to continue to stabilize or even go up. So how are you able to provide financial engineering in a best-in-class manner to tap into those capital markets and have the best performing preferreds and have the ability to make an announcement of 10,000 Bitcoin in a week? And how are you able to do that, and how this is shaping the new wave of adoption for financial markets with the instruments of Bitcoin treasury companies?
You know, I think our first challenge was to develop a set of metrics that you could use to value BTC-backed equity. And because you're on a Bitcoin standard, simple USD, US dollar accounting doesn't really work, because US dollar accounting is geared toward companies that generate their earnings via operations. And so, you know, we created BTC yield, which is basically the accretion of Bitcoin per share in a percentage. And the idea of that is if you've got a 20% BTC yield, you could put a multiple of it on it like 10, and you could come to a 200% premium to NAV. It's a very simple way to get to what should the premium to NAV be. Well, it comes down to whether the company generates 220% yield or 10 or 200% yield, right? And a bond that pays 200% interest after tax is worth a lot more than a bond that pays 5% interest after tax, right? So the yield metric was an equity metric. BTC gain or dollar gain is an equity metric. A BTC dollar gain is basically the earnings equivalent for a Bitcoin company. It's on a Bitcoin standard basis. If you generated $100 million of BTC dollar gain, it's like $100 million of after-tax earnings. It goes direct to shareholder equity. It bypasses the P&L. But a company that can generate $1 billion of BTC dollar gain is like a company that generates $1 billion of earnings, right? And you could use a P to E on that and say, well, I'll assign a P to E of 10 or 20 or 30 or whatever times that gain, and that gives me an enterprise value for the operation and their ability to do it. Now the question becomes, how do you generate BTC yield, and how do you generate BTC dollar gain or BTC gain? And there's three obvious ways to do it. One way is operating cash flows. I take my operating profit and I sweep it into BTC, and that becomes a yield and that becomes a gain. That is, I have $100 million of operating cash flow and I buy Bitcoin with it. Then I have $100 million of BTC dollar gain without any shareholder dilution, right? And so that's one way to do it. You need an operating company that generates a lot of cash to do it. The second way to do it is if you sell equity at a premium to NAV. When you're selling $100 million of equity at a 2M NAV, then you capture a $50 million BTC dollar gain. And of course, if you sell equity at a discount to MNAV, you're actually diluting the shareholder. So you would have a negative yield, a negative gain. I think the reason that BTC yield and BTC gains matter is it's a very simple, transparent, instantaneous way for an investor to see whether the management team took an accretive transaction or a dilutive transaction. On any given day, any public company can raise almost any amount of money if they're willing to dilute their shareholders. And the real trick is to do it accretively. So those two metrics, are important. But now we've moved through this issue. I've run out of cash flow. What do you do if the BTC, if the MNAV is 10 or 5 or 8? This is not a complicated question. When you're on fire with an MNAV of 8, you sell the equity, you buy the Bitcoin, at an MNAV of 10, you've got like a 90% spread, right? So you're generating $900 million of gains for every $1 billion of equity you're selling. It's risk-free, instant earnings, in essence. That's not complicated. The question is, what if MNAV goes to 1 or it goes below 1? What if you don't have any cash flow and MNAV goes to 1, but you have $1 billion of Bitcoin on the balance sheet? Well, if you're a closed-end trust like Grayscale, right, or if you're an ETF, but especially a closed-end trust, you can't do anything, so you'll trade at a discount to MNAV, and that's always the thing people wanted to avoid. The special power that an operating company has is to issue credit instruments, though. And so the way that you actually pull yourself out of a hole if you trade at a discount or you trade down to normal MNAV is you start to sell credit instruments collateralized on the assets of the company. So that takes us to the idea of BTC credit models. If I have $1 billion of Bitcoin, I can sell $100 million of a bond or let's say $100 million of preferred stock that yields 10% dividend yield. It's 10 times over collateralized. So therefore, the BTC rating is 10. You can now calculate the risk. The risk would be the risk that your $1 billion of Bitcoin trades to less than 100 million by the time of maturity of the instrument. you can calculate that statistically the same way you calculate Black-Scholes models. You plug in the volatility, you plug in the BTC rating, a risk pops out. Then you can calculate a credit spread, what we call BTC credit. What is the theoretical credit spread above the risk-free rate that you need to offset the risk? And of course, the credit spread, if the BTC rating is 2, is higher than if it's 10. And if Bitcoin volatility is forecast at 50, then the credit spread has to be higher than if the Bitcoin volatility is 30. So if you plug into your model your expectation of Bitcoin return, or ARR, over a decade, and you plug in your expectation of volatility of Bitcoin, and you plug in the price of Bitcoin, you get a BTC rating. The risk pops out. The BTC credit model pops out. What we have done is used that in order to start to issue Bitcoin-backed credit instruments. Our idea is we want to sell securities into a market that's orthogonal to the equity market and to the Bitcoin market, or an uncorrelated market. So the market for US dollar yield, right, amongst retirees, there are a lot of people that don't know what Bitcoin is, don't know what strategy is, they don't know anything about our business model. But if we offer them, like we offered a preferred stock that yields 10% dividend at par, we offer you 10% dividend yield and a qualified income distribution, a QID or QDI qualified type instrument. If you make less than $48,000 a year, you can buy the instrument and collect 10% dividend yield tax-free in the US. Okay, well, that's interesting. A lot of people want 10%. Now, the issue is it risky? Well, if it's 5x or 10x over collateralized, then it doesn't look that risky if you think Bitcoin is a real thing. So the idea of giving someone extremely low risk but high yield fixed income is a simple idea. I think it's kind of a killer application for Bitcoin as collateral. What we did at Strategy is we created a convertible preferred called Strike, which gives you 40% of the upside of the stock and an 8% dividend at par. And then we created a senior preferred called Strife that gives you 10% at par. That is cumulative. It means the dividends, if you ever miss them, they accumulate, and there are penalties. And so it's senior to all the other preferreds. And those two were the two most successful preferred stocks in the century. That is the most liquid, the highest performing. They all traded up 25% when the other preferreds were trading down 5%. And of course, they're the most successful because any security backed by pure Bitcoin is always better, right? The options are more valuable. The equity is more valuable. The convertible bonds are more valuable. These preferreds are more valuable because you're plugging in an asset which is going up 55% a year with 55 vol. And so if you plug in something which is spinning at 55 RPM that's going 55 miles an hour, there's a lot of energy in it. So we just plugged that into those instruments. They were very successful. We floated them in the public market on NASDAQ, and we attached a shelf registration to them. And the idea is now we can sell people 40% of the upside of the stock, and that might be 80% of the upside of Bitcoin, but with downside protection and a guaranteed dividend. So we call Strike. It's like a Bitcoin fellowship. It's like you get a living stipend, you get protection, and you get to ride the upside, and you can hold it forever. And that's for the Bitcoin curious that are afraid to get on the roller coaster, which is Bitcoin, or the hyper roller coaster, which is the equity, the turbocharged Bitcoin and MSTR. But then there's a lot of people that don't want Bitcoin exposure. They just want US dollar yield or Euro yield or JPY yield. And so, how many people is that? Well, that's like every retiree in the world. That's like everybody. There's no one that doesn't want 8 or 10% dividend yield at extremely low risk. That's why the credit markets, fixed income markets, are bigger than the equity markets. So what we did there is we're just using Bitcoin to generate that. And if Bitcoin is going up, it's been going up 55%. So you can pretty much slice any amount of yield out of less than 55%, and you can give it to an investor. And, I think a Bitcoin maximalist long-term forecast is 30%. But I figure Bitcoin's got to yield between 20 and 60% a year forever. And as long as Bitcoin is returning 20% or more, you can always sell these instruments offering 6, 7, 8, 9, 10% and swap it into 20, 30, 40%, capture the difference for the equity investors, and that way the equity outperforms Bitcoin. The convertible, you can probably, and here's our engineering, we're basically engineering the company for the equity to outperform Bitcoin by 50 to 100%. Then you've got Bitcoin. If you want straight Bitcoin, you buy it from iBit or you buy the BTC and you hold it yourself. And then we're engineering, but you're getting all the upside and the downside of Bitcoin, all the volatility. Then Strike, the convertible instrument, is engineered to give you 80 to 100% of the performance of Bitcoin, but with 10% of the downside. So we want 80% of the upside, 10% of the downside, and a guaranteed dividend. So that's for people that kind of want to have their cake and eat it too, and they don't want the roller coaster. And it almost is meant to compete with iBit. If you think about it, it's like instead of 100% of the upside, 100% of the downside, and no dividend, what if I gave you 80 to 100% of the upside? I don't know if it'll be exactly 100%, but the more we lever the equity, then the more likely the convertible equity becomes equal to Bitcoin performance. So we're shooting to get the convert to perform the same as Bitcoin over the long term, but with principal protection and liquidation preference, and with the guaranteed dividend stream. And that's that thing. And it seems like there's a market for people that want the upside without the downside, right? And right, I mean, that's the engineering. I give you the upside, you have no downside, and I pay you a dividend while you wait to get rich. Okay? Which is the smart financial engineers, in my opinion, agree with me. They're like, oh wow, this is a good idea. But a lot of people haven't quite figured it out yet because nobody's ever issued a perpetual convertible preferred stock. The last 10 preferred stocks issued in the last 4 years, the top 3 of the 10 were ours, and they're all perpetual, and all the other 7 aren't. People don't normally sell a perpetual dividend or a perpetual call option because they don't have a perpetual use of proceeds. They can't invest in something for 100 years. And so the Bitcoin superpower is, if you're a Bitcoin believer, you think Bitcoin is going to outperform the S&P index forever. And if Bitcoin outperforms the S&P index forever, you can sell a dividend that's less than the S&P forever. And then you can also sell a convertible preferred that outperforms, right? That's good forever. So we engineered that, and then the idea with the fixed is we're going to give someone an infinite duration dividend yielding, and the conventional thinking is, you're crazy, you should have a call option in it so you can retire it if interest rates fall. And that's the way a conventional banker's like, they all like, you should put a call option and then you call it. If the interest rates fall 200 basis points, you'll call it and you'll refinance it. But that's the way you think if you sell 144A over-the-counter instruments with a 3-year duration to trade in the over-the-counter market. But those are all crippled 20th century instruments. The way you think in the 21st century is, I'm going to put Strife into the market, and I don't care how much I sell in the first week. I'm creating the instrument so that I will maximize the amount of capital I raise over the next decade or 20 years. So we wanted to create the instrument so that If Jerome Powell drops the interest rates 200 basis points, Strife trades up to 150. And when it trades up to 150, the yield falls to 6%. And when so instead of 10, it falls to 6, and then we're able to then sell it. I'm not buying it back. I'm selling it, right? The whole idea is when the interest rates fall, I will be selling billions and billions of dollars of that instrument via the ATM at 150 or 200. And the small thinker thinks, oh, I have to buy it back, refinance it, go back and do a 144A deal with the investment bank with a huge commission to refinance it, and then that'll be illiquid and crippled. And so I don't want to issue a series of crippled, illiquid securities. And by the way, what I'm describing, the entire preferred stock market. All of the preferred stocks, in my opinion, are garbage, right? You're buying these garbage instruments that are illiquid, that trade $400,000 a day, that yield 6%, that have the credit of a mid-sized regional bank in a state you've never been to, with mortgage portfolios you don't understand, and you're supposed to accept 6% illiquid over-the-counter that nobody can buy, instead of something which yields more, which is 100x as liquid that everybody can buy. And of course, the problem is all that corporate credit, all of that preferred, it's all 20th century ideas on 20th century credit models. So what we did is we concluded the killer app for a Bitcoin treasury company is to issue credit. Bitcoin-backed equity, that's the first app. And yeah, you can do that for a while. But the long-term durable business is to issue BTC-backed credit instruments and issue billions and then tens of billions and then hundreds of billions. And you're not competing against other Bitcoin treasury companies. You're competing against every junk bond sold by every company with no money, every corporate bond sold by an investment grade company. And guess what? We're more collateralized than the best investment grade companies issuing corporate bonds. We have better collateral. So we're competing against corporate bonds, investment grade bonds, junk bonds, private credit, and then against preferred stock in that market. And the idea is we're just going to sell something that is more creditworthy, less risky, better collateralized, that yields more, that's more liquid, that everybody understands. And ultimately the goal is instead of a market of 1,000 preferred stocks with 500 million in the float each that are illiquid, that are garbage, how about one preferred stock with $50 billion in the float that trades $2 billion a day, that yields more, that everybody's heard of, that's backed by Bitcoin, right? And to do that, you just kind of adopt those metrics. And what I just described, every Bitcoin treasury company can copy. I invite you to copy it. I encourage you to copy it, because just like 20 BTC companies issuing equity legitimizes Bitcoin and Bitcoin equity, 20 companies issuing Bitcoin-backed credit instruments will legitimize Bitcoin-backed credit, will accelerate the digital transformation of all the credit markets and create a stampede of capital out of the 20th century defective, crippled credit instruments into the digital credit instruments of the 21st century. And S&P and Moody's and Fitch, they'll all just start to cover that. Everybody's view of credit risk will evolve. The retirees get 200 basis points more yield on something which is an order of magnitude less risky. Bitcoin goes to $1 million, $2 million. As Bitcoin goes up, the collateral goes up, the markets all evolve. And what I'm describing is the way that I see the digital transformation of the capital markets driven by these BTC companies.
Thank you so much, Michael. All right, so we have about 30 minutes left. I will ask a last question to Adam and then open to the Q&A, so please prepare your questions. What we are witnessing really is Bitcoin as the standard store of value for capital markets, Bitcoin treasury companies that are securitizing Bitcoin and providing access to various capital pools. And have you seen very well described by Michael, like the ability of Bitcoin treasury companies to create new financial instruments for various pools of capital. And of course, that's a monstrous opportunity. And as you mentioned, Michael, it's not a competition. We are collaborating and creating an industry and on the same mission to get Bitcoin at the core of the capital markets. And Adam, here with us, has been working for a long time on digital capital markets as well. So we'd like to get your perspective, Adam, on potentially first some risks and trade-offs to take into account when it comes to Bitcoin capital markets, and how you've built also solutions for 24/7, 365 capital markets, and how do you see the evolution of the role of Bitcoin treasury companies within the transformation as well of Blockstream, within the asset management industry for the adoption of Bitcoin, and how do you see this impact of Bitcoin treasury companies overall into capital markets?
Yeah, so as I might have mentioned, I think that Bitcoin is the hurdle rate. So that's effectively, the fiat currencies are suffering a lot of inflation, and Bitcoin is best performing asset class of the last decade. And so, if you realize that, you don't want to invest in anything that isn't competing with Bitcoin. Very, very hard to compete with Bitcoin. So the obvious solution is to redenominate the companies in Bitcoin, base their treasuries on Bitcoin, and use the profits from their enterprise to buy Bitcoin, and use the capital markets structures that Michael has been describing to improve that cycle, and play with the arbitrage to bring forward the Bitcoinized future. Now, in terms of risks, I described the sort of MNAV varying over time, and you see companies reanimating their MNAV. So they'll get a compressed MNAV and they'll recover from that. And so, strategy's been around the longest, and I was an early investor in it. So I was actually buying it at times in the bear market, with the first bear market that a treasury company has been through. Actually, the rest of the treasury companies haven't been through one. And to my point of view, it was cheap, so I was buying it. And as Michael's described, that there's an incentive within a company, and this is why companies do share buybacks. If your own equity is mispriced, you want to buy it. And so, if you've got cash reserves, you can buy it. In a Bitcoin setting, the more effective way is to raise capital from these uncorrelated preferred instruments that Michael set up, the Strike, Strife, and Stride, and use that capital to buy back your own equity if it were to get below 1. I'm not sure that it would necessarily, because there's a lot of people looking at the companies who would buy it, at 1.5 MNAV and also consider that cheap. So maybe it can't quite get there. And I think in terms of risk, it depends on your investing horizon. I'm generally a value investor, a long-term outlook. So I tend to not like selling things. I don't like selling Bitcoin. Once I get into a treasury company, I kind of want to hold on to it and ride the, their ability to accumulate Bitcoin over time, because that improves, your entry point is now historic and they've accumulated more Bitcoin than the MNAV when you bought it, then you're kind of quite well insulated. So I think, people who create a risk is more by trading in a very short-term viewpoint. You see that in the Bitcoin market, and I think that same kind of risk can exist in the treasury company market, which is if you're prone to sell something because the market's volatile, you need to slow down and take a longer perspective, and realize the Bitcoin cycles come and go, and of course you have short-term volatility in anything. It's there is no risk-free return, so of course you're taking on a risk by doing anything. I do find the fact that the treasury companies are accumulating Bitcoin, which is sort of de-risking behind your investment. So if you were to let's say, let's take Metaplanet as an example, and its MNAV is ranging between 5 and 10, there was probably a point in time when it got a bit above that, right? So if you picked it up at 12 and it generally is not going back there, you might think, oh, now I'm stuck. But that's just not really what happens, because after a few months, relative to your entry, they will have accumulated more Bitcoin. So it will become as if you bought it at 10 a few months later, and then over time it kind of decays. So I like the phenomena that it sort of forgives too hot of an entry, makes it a sort of forgiving type of investment. But of course, with any company, you are trying to understand what where the risks are in terms of trust. The operational capability. Are they good at executing? Will they stay good at executing? And what mechanisms are they doing? Are they repeatable? Are they scalable? So if the company gets bigger, they can go bigger. Say, instruments like Strike and Stride and Strife that are drawing capital from debt markets, which are enormous, is positive for scalability. And I think in the Bitcoin markets, there are people who are long-term investors, value investors, who just buy Bitcoin and cold store it, and that's great. But there are also some speculators, and so for people who like speculating, they like volatility. And a treasury company tends to have an amplified volatility compared to the underlying, and it's an interesting trade because part of what creates volatility in the Bitcoin market is that people find themselves all in. So, or they're at their allocation risk, and so they see a lower price, and they don't have any more capital, so they can't buy it, or they use leverage, which then they can misjudge. So there's a shortage of capital to buy pullbacks in the Bitcoin market, and so what I was finding attractive, apart from supporting the treasury company mission, as part of the overall Bitcoin mission to Bitcoinize the world, is that you could trade a strategy company using Bitcoin as the denominator. So you have basically a Bitcoin basis trade. So if you see a strategy company and you think its MNAV is cheap compared to its normal range or compared to monster cover, you can buy it with Bitcoin. And when it looks overheated or it's normalized, you could swing it back to Bitcoin. Now, typically, if you try that, you'll realize over time that you probably would have been better off to just leave it in there, because they're continuing to accrue Bitcoin, and you're playing with market timing. But at least it's Bitcoin denominated, so your fallback is you're in Bitcoin. And also, as a kind of stubborn value investor, I won't typically want to realize a loss, particularly a Bitcoin denominated loss. That's a very upsetting phenomena. So that's where the HODL meme comes from, right? That the guy was extremely drunk, but making a very salient point that if you sell Bitcoin, you are short Bitcoin, and that's very dangerous. I arrived at this conclusion very early in my Bitcoin experience in 2013 or something, that the price of Bitcoin is going up exponentially. Even then, it's kind of fractal, right? So it's doing the same thing again and again and again if you zoom out. And if something is going up exponentially and it has very high volatility, if you were to sell, the odds are stacked against you, because it's just inexorably, if you zoom out over time, going up. So you're really taking bad odds to sell and think you'll be lucky and buy back in, because the market's moving against you generally. So I never want to sell Bitcoin, and so I think so I think there's a new market evolving here, which is to price treasury companies in Bitcoin. And so at Blockstream, we have some Bitcoin layer 2 technology. We are participants in the Lightning phenomena. We have one of the implementations of Lightning called Core Lightning. I think it was the first one to go live with a real value web store that's still running today. And we have another layer 2 called Liquid, which is a sidechain technically. And with a sidechain, you can introduce new features. So one of the features of the sidechain is you can issue assets on it and use it as a settlement layer or trading layer for limit orders and trustless settlement and execution and simple smart contracts like call options and so on, without an intermediary. No, those kind of instruments are typically settled with a back office where you're trusting an intermediary. So you can do this, and there are wallets that support this kind of technology, including some that have trading features in them. So there's one called SideSwap, which has it's by a Swedish company. It has a central order book, but you're able to trade on it, place limit orders on it, while keeping your assets, which could be Bitcoin, MicroStrategy shares, Metaplanet shares, probably soon BG, the blockchain group shares. And what you're actually participating in is a properly licensed, regulated security, even though it's in a blockchain format. So how that particular one is set up, but it could be done in different ways with different legal processes, is the units are Luxembourg securitization vehicles, and you are trading units of this securitization vehicle. And you have to enroll to access that market because rules differ in different countries. And whenever you transact, I could pay for my share of a lunch bill using a few hundredths of a Metaplanet share, and even that small action results in a share registry update in a database. So it's real-time updated, it's regulated, and yet it feels permissionless. You can transfer it. It's kind of more modern digital share certificate with a bearer-like behavior in the sense that you have the share certificate and you can swap it, you can transfer it, and it's very real-time, but it is updating the classical share registration database with a registered owner. And actually, if you lose the keys, you can go and apply to the share registration agent, and they can lock the previous one for transfer and replace the certificate. So anyway, with that market, you have on a SideSwap order book actually Bitcoin denominated pricing for a few treasury companies, and more over time. Now that provides two advantages. One is if you are doing this kind of trading, you are typically going to sell a Bitcoin ETP or ETF to dollars or euros, and then you can use the dollars or euros to buy, BG, the blockchain group, or Metaplanet, and then do the reverse. So you're taking two trades every time, and these prices are moving. So it's you can slip quite a lot with that. So it's inefficient, and also the markets are not 24/7. So if you live in Europe and you try to trade Metaplanet, the market opens at 2 a.m. for your perspective. It's not good timing. So with these tokenized treasury stocks, you have a 24/7 Bitcoin denominated market that trades on a weekend, it trades in your time zone, and it's more uniformly acceptable. So you see when you see new treasury companies come into market, BG a while ago, you still see threads on social media where people are asking, how do I get to Paris Stock Exchange? I can't, I called Interactive Brokers, or I called this, or Fidelity, and it's a bit uneven. And so this provides kind of more uniform access. Another one which it seems to be even harder to get at is H100, a new treasury company incorporated in Sweden on the Nordic growth market. And same thing again, people are trying to find where can they buy it. Of course, that's it gives the local market participants faster access to it. And maybe they have some unique advantage in their home country, as Michael described. So that's a kind of interesting new sort of digital capital market technology. And there's interest from exchanges now who are adding securities licensing so that they can trade securities in a Bitcoin exchange. And so you have Bitfinex announcement. So Bitfinex was one of the first to get this kind of licensing. I think now you see Kraken making some announcement that they're going to start, more recently Coinbase. And so the concept here is that you can have sort of standardized Bitcoin layer 2 tokens for the treasury stocks and be able to deposit them on a custodial exchange, trade them with high velocity on there, and withdraw them and move them to other exchanges. You also have the possibility, because it is tokenized, to use that as collateral to borrow. Of course, you could borrow dollars, that's a common thing, But because people are engaging in a Bitcoin basis trade, you actually have now a natural and new market to borrow Bitcoin to apply leverage to that trade. So, if you are trading Metaplanet, it's quite volatile, so using leverage on that might be a little risky. But in any case, you could apply a low leverage where you're basically borrowing a bit of Bitcoin against Metaplanet to buy more Metaplanet and unwinding that on the way back. So it's really unlocking, a Bitcoin basis view of a lot of capital market structures where margin trading is all dollar or euro based margin. In the traditional markets, it's very clunky. The market's not 24/7. The leverage they can provide is very variable. So in some sense, it can expose you to artificial margin call or liquidation risk because they have a very, very conservative view on leverage unless you are, a hedge fund that can negotiate something more custom. So we're finding this quite interesting and opening the doors for, you saw that Stocker, who is the Luxembourg securitization licensed entity doing the first two treasury stocks in this format, made an announcement of partnering with H100 to do some more elaborate things like a convertible note that's tradable that you can, pay for the conversion and receive the share, with a few clicks rather than, go through the conversion paperwork and, wait a few days to get the shares to show up in your brokerage account. So you get this much more accelerated process, which is interesting to see as well. And you're literally exchanging some Bitcoin, a tokenized convertible note, or a tokenized share in a sort of trustless market, a non-custodial order book or market service, and you can exercise a convertible note. So that's not built yet, but it's pretty easy to build with these kind of tools. So you might see that pretty soon. That's interesting as well.
All right, thank you so much, Adam. I guess something that Adam mentioned quickly to end the panel and open for maybe one or two questions is Bitcoin investment, and as Michael mentioned many times, the right horizon for Bitcoin is at least 4 years, and the best one is forever. And so we talk a lot about Bitcoin treasury companies, and the opportunity is enormous, but we are here for the long term, and I think that the opportunity should be looked in the long term and to be careful as well in the market. So is there any questions? Okay.
That was a yes, listen.
Thank you very much. This is Enia from the blockchain group and BTC Treasury and the X community. And my question goes to Adam and also Alexander, if you feel like commenting. So the blockchain group is the first and only, as far as I know, as of today, company using and issuing BTC-denominated convertible bonds. And what I noticed is that people who first hear this kind of struggle to wrap their head around that. So my question is, what are actually the incentives on both sides for the company issuing the bond and also for the bond subscribers? Why, for example, a whale should decide to use their Bitcoin that way in comparison to other alternatives available?
Yeah, so I think the incentive for the Bitcoin basis convertible for the investor is they hope that the market price reaches the conversion premium. So we talked about the blockchain group. They issued some, not fairly recently actually, that with a 30% premium above the market. That was the price you paid because there was an embedded option which commanded the conversion premium. And then so that's the purchase price of the convertible, and then there's another 30% above, which was the conversion premium. So I think the attraction for the investor is that they could, put Bitcoin into it, hope that the conversion premium is reached, quickly or in the long term. It's a 5-year instrument, and if it does reach the conversion premium, then you can convert it. and you can hold it if you want to participate in a company's continued treasury strategy, or you can sell it and buy back a little more Bitcoin than you put in. And in terms of the rest of the structure, there is a 3-year period where the investor can opt to convert. You're not obliged to convert. And then after that, it's a 2-year period where the company, as long as you have the premium, because you can't convert if you don't have the premium, and for the last 2 years, the company has the option to convert if it's above the premium. So now the thing that makes that lower risk is 2 factors. One is the debt ratio is kind of 0 because, you know, if it doesn't convert, you know, the risk point is at maturity. If it doesn't convert, the company has to give the money back. And if the money was euros and Bitcoin price was low, they won't have to raise money in the markets, or maybe they'd do something dilutive to come up with the money or refinance it or something, right? So lots of tools, but nevertheless, with Bitcoin, that kind of tail risk, I mean, most Bitcoiners think that Bitcoin will be a lot higher in 5 years, so they're not too focused on that anyway. But that tail risk, if it's Bitcoin and they have the Bitcoin independent custodian, in that tail risk situation, they can just simply transfer the Bitcoin back and cancel it, right? So it's a kind of money back kind of feel. So people like money back kind of feels, right? And then what's in it for the company is when the investor converts, the company gets more Bitcoin. So they've generated a bookable yield in terms of Bitcoin per share. And in fact, the blockchain group, first instance of this, had an embedded option to participate in a second bond, second convertible note, with a 30% higher price and another 30% higher conversion premium, and 1.5 times the money that you invested in the first one, you had a pro rata right to. And because it happened relatively quickly, it was you know, a curious experience, right? Which is that you invested a certain amount of money to your allocation preference, and now suddenly you have to find 150% more money, but it's in the money, so you're gonna want to do it, right? So that kind of pulled forward a lot of demand and helped, I think, ultimately helped the blockchain group have this very rapid growth. And I think the other thing is that because of the sort of being Bitcoin related debt, that they had a very high nominal yield at the beginning because they had 40 Bitcoins from private placement money in November 2024. And then they raised 580 Bitcoin using this Bitcoin basis note without an embedded option. And so if that was a euro debt, it would be an enormously leveraged position. But because it was a Bitcoin debt, that felt like a relatively safe thing to do. So they're able to book a very rapid rate. So please correct me if I got some details wrong.
Yeah, I think maybe a
You
question
lost
for
your
Michael.
microphone. You should go get it.
Yeah. Yes.
Or just go walk through the audience and ask them questions.
Yes, question to Michael. So thanks first of all for being live for us, for making the
Does he have
industry
another
people
mic?
companies. This is not one. Yeah. So my question is, at least in my view, there is some kind of issue that financial engineering on top of Bitcoin grows, but at the same time we see more and more centralization on the, let's say, technical side of things. I would like to ask if you see this concern and what can be, I don't know, social, economical, maybe financial ways to fight it. What I mean is like centralization of pools, an amount of nodes that are getting lower and things like that. Like, do you see it as threat? And if yes, what do you think we could do to fight it?
I don't think it's a threat. I think the network is decentralizing, and I'm not concerned about the pools. I think that the Bitcoin mining network is decentralizing everywhere in the world. It's far more decentralized today than it was during the China lockdowns when China shut down their Bitcoin mining. And when China was mining half of it, that was sort of centralized. And then it migrated to the U.S. and in the past year or two, it's migrating out of the U.S. and spreading everywhere in the world. And at the end of the day, I don't think the pools have that much power. I think that the power rests with the economic actors. It rests with the economic nodes. It rests with political actors. It rests with the Bitcoin miners. It rests with a bunch of tech providers. There's a lot more parties that are engaged in consensus today than there were 5 years ago. And I think the mining pools are much weaker and, again, largely irrelevant. Any mining pool that wanted to drive any particular policy would and could be fairly quickly overridden by all the other economic actors or technical actors in the space right now. So I actually think Bitcoin is at its most robust it's ever been, in my opinion. And so I think we're good. There's going to be people concerned about everything under the sun all the time, and I think that's healthy. It's healthy that everyone's worried about this protocol change or Bitcoin Core or this mining pool. That's a healthy degree of skepticism, but I wouldn't interpret that healthy immune response for the network being weaker today. The network is far stronger today than at any point that I can remember or point to.
Right. I think Adam gave already a very good answer on the BTC convertible note. So if you have more questions, I'll be available later on. Maybe if there is another question to close the discussion.
Hello, so I prepared it because my English is not so good. So we've discovered that there is a global trust law fraud connected to legal names worldwide, affecting even all KYC processes on the exchanges. And my friend Victor has a little gift for you about this. And my question is, you often suggest also before in the talk that you are using company structures to protect yourself. Is it also connected to the names? But what happens if large private or institutional actors continue operating directly under their personal names? What would you recommend to avoid long-term legal risks as the global structure becomes more exposed?
I'm not sure I understand the question. Can you say it again?
Okay, my question is, so on all the KYC exchanges, there is the problem that they use the wrong names. They change it and it's not the legal names as you have it in the passports. So if you act as a company, you don't have the problem. But when you have big investors like institutional investors, they use their personal data, so their normal name, and then you have you have the problem with the tax institutions and with the tax companies because they have changed it. But yeah, he has some information about it if you are not.
I think that Bitcoin is spreading everywhere in the world, and you can choose to engage with it peer-to-peer with self-custody and bypass the exchanges. I think you can look at Bitcoin as one world of Bitcoin where it's all individuals working with each other, and there are a lot of different ways you can do that, right? I mean, there are various individual strategies or techniques where you're not working with an exchange and you're not working with a company. I think there's a second way to view Bitcoin, which is what if 400,000 companies all trade peer-to-peer with each other and bypass the exchanges and the banks? I think there's a third way to view it, which is what happens if 50,000 banks start to hold it and trade with each other peer-to-peer. I think there's a certain way that people are dealing with crypto exchanges today, but that's dynamically evolving. I think that as the digital assets environment becomes more flexible, I think you'll see an explosion of innovation. And the innovation is taking place at the country level and it's taking place at the individual level. And whatever is the status quo today probably won't be the same in 5 years. And there'll be some countries that will err on the side of more liberty and freedom and privacy. And they will develop very good technologies, and those will probably spread everywhere else in the world. And there'll be other countries that err on the side of KYC and censorship and not privacy. And I think it's not a Bitcoin problem. It's a nation state or citizenship problem. If you find yourself in a particularly hostile nation state where they deprive you of your privacy or your economic liberties, then of course the answer is you're either going to use technology that came from another place, like VPNs and firewalls and the like, or you're going to move. But I think Bitcoin, because it's global, is it's allowing every nation, every actor everywhere in the world to develop technology for layer 2, layer 3, layer 4 protocols as fast as they can. There are things that are being done in countries that you don't live in that would be illegal in your country or not culturally acceptable. And you will probably, as a Bitcoin holder, you're the beneficiary of someone doing something in another place that might, if I own Bitcoin in Cuba or North Korea, I'm getting rich, even though it's illegal to own Bitcoin in Korea and Cuba. And likewise, a lot of good technology will flow from the U.S. into countries that wouldn't allow it, and there'll be technology that flows from other countries into Europe where it may not be allowable. And I think that's dynamic equilibrium. There's no one answer except for the fact that it's pretty clear that if you're looking for the best answer is going to be a decentralized network like Bitcoin and then decentralized layer 2 protocols like Lightning. And they are most likely to provide the most sovereign resistance and sound money properties that you could get. There's no second best idea. So a friend of mine says, things aren't necessarily perfect here. That's why we call it Earth and not heaven. And I would say with regard to this, there's always going to be imperfections in people's implementations of Bitcoin. That's why it's Earth, it's not heaven. But the second best idea is much, much worse than that. And what Bitcoin gives us is it gives us hope that if you are stuck in a place where you have an imperfect capability or imperfect execution, somebody somewhere else in the world is probably working on something better. And once they roll it out, it will start to either directly or indirectly improve your condition as a network participant. And so I take that incremental approach, and I don't get demoralized or depressed if I see there's a suboptimal thing. If there's some exchange or some wallet that did something I didn't like, I just accept the fact that we move forward, sometimes imperfectly, 2 steps forward, 1 step back. And that's all human progress takes place. And if you're too much of an idealist and you demand that everything be perfect everywhere at all the time, throughout the journey, you never get started on the journey and you'll never get to a better place. And I think we're moving to a pretty good place right now. And on the margin, you have $2 trillion of economic energy in the network today that is imperfectly distributed to some actors. But 10 years ago, you had a few $1 billion of economic energy in the network. And it's not like the network was more functional then or all the applications were better. So I think we're better off today. And now that everybody sees the excitement, you're about to see the best and brightest minds everywhere in the world start to spend orders of magnitude more money on programming and innovation in layer 2s and layer 3s in order to cure all the problems that you identify. And I agree there's lots of problems in the world. I think that Bitcoin is a movement and a technology and a protocol that provides us with a hopeful path to get to solutions that are better than anybody else has proposed with any other protocol that I am currently aware of.